What are accounting policies and how are they used? With examples. Please watch if you're interested. If not, scroll along. Have you ever wondered how companies decide the exact way they record their finances? Because accounting isn't just writing numbers down, there are rules behind how those numbers are handled. Those rules are called accounting policies. Accounting policies are the specific principles, methods, and procedures a business chooses to use when preparing its financial statements. In simple terms, they are the company's chosen financial rulebook. Rulebook. Let's break that down. There are many areas in accounting where a business has choice to make. For example, how it would calculate depreciation, how value it should value inventory, when it should recognize revenue, when different methods exist. The company must choose which to approach it will consistently follow. Ay, ay, ay. The chosen approach becomes part of its outstanding policies. For instance, one company may use straight line depreciation for equipment, while another may use reducing balance depreciation. Both are valid, but the policy tells us which method that company has committed to using. The same goes for inventory. Business may choose FIFO, meaning first in, first out, or weighted average costing. Again, the chosen method becomes part of the company's accounting policy. Now, why do accounting policies matter? Well, because they create consistency. If a company changes accounting methods every few months, its financial reports would become confusing and unreliable. Investors, lenders, and managers wouldn't know how to compare one year to the next. Accounting policies make sure the numbers are prepared in structured, repeatable way. They also create transparency. Businesses usually disclose their key accounting policies in their financial statement so readers can understand how the numbers were produced. Let's look at the quick example. Imagine two companies, both buy the same machine for $10,000. One depreciates every evenly over 5 years, the other depreciates it faster in the first years. Even though they bought the same asset, their profits will look differently because their accounting policies are different. That shows the powerful these policies are. They directly shape the financial picture. A common misunderstanding is thinking accountable policies are universally fixed flaws. They are not always. Accounting standards give frameworks, but business still makes method choices within those frameworks. Another misconception is that accounting policies are minor detail in hidden reports. In reality, they can significantly affect profit, assets, and how healthy business appear. So, what's the key takeaway? Accounting policies are methods and rules a company chooses to prepare its financial statements. They create consistency, transparency, and comparability, but they also influence how the company's financial story is presented. And once you understand accounting policies, you realize financial statements are not just numbers; they are numbers shaped by chosen methods. Thank you for watching.